Asian stocks slip with bond yields on recession fears earlier than Fed. Tokyo Asian shares misplaced ground on Monday, taking flight from over 3-week highs as worries approximately a worldwide economic downturn sapped traders' hazard appetite. Bond yields eased amid bets that an expected U.S. recession might graduate the Federal Reserve's aggressive tightening marketing campaign, with markets seeking out policy clues from its two-day Federal Open Market Committee meeting which begins on Tuesday. At the identical time, the dollar constructed on its recovery from a 21/2 week low against foremost peers, supported via demand for the U.S. foreign money as a safe haven. Risk markets are obviously priced for some type of slowdown, however, are they priced for an outright recession? I might argue no, said Ray Attrell, head of foreign money method at National Australia Bank (OTC), NABZY. In that experience, it's hard to say we've reached a bottom as far as risk sentiment is concerned. Japan's Nikkei retreated 0.75%, at the same time as Chinese blue chips misplaced 0.82%. Hong Kong's Hang Seng slid 0.75%, with its tech index tumbling 1.96%. MSCI's broadest index of Asia-Pacific stocks lost 0.54% to 158.80, after touching the best considering that June 29 at 160.03 on Friday. U.S. S&P 500 E-mini futures slipped 0.08%, pointing to an extension of the benchmark's 0.93% slump on Friday, when a survey confirmed business interest contracting for the primary time in almost years amid persistently heated inflation and swiftly growing hobby fees. Earlier that day, statistics also confirmed Euro area organization interest suddenly shrank. Nasdaq futures were about flat, following a 1.77% tumble for the tech-heavy stock index, as the bottom dropped out from underneath Snap Inc. (NYSE) Snap, after the Snapchat owner published its weakest ever sales increase. Investors are on guard this week for how an awful lot a sturdy dollar will hurt financial results from heavyweights Apple, Nasdaq, AAPL, and Microsoft, Nasdaq, MSFT, amongst others. In Europe, Euro Stoxx 50 index futures pointed 0.61% lower, and FTSE futures slid 0.52%. The dollar index, which measures the safe haven currency towards 6 important friends, became little changed at 106.64, after mountain climbing off a 21/2 week low of 106.10 reached Friday. The greenback brought 0.11% to 136.235 yen, even as the euro slipped 0.04% to $1.02075. The 10-year U.S. Treasury yield changed into little modified at 2.785% after sliding from as high as 3.083% over the previous two sessions. Equivalent Japanese authorities' bond yields dropped to the lowest because March 10 at 0.18%, and Australian yields dipped to the bottom in view that May 31 at 3.285%. The Fed concludes a two-day assembly on Wednesday and markets are priced for a 75 basis point charge hike, with about a 9% chance of a complete 1 percentage point growth. Crude oil fell on situation that better U.S. fees would limit gasoline call for boom. Brent crude futures for September settlement dropped 48 cents, or 0.5%, to $102.72 a barrel, and U.S. West Texas Intermediate (WTI) crude futures for September transport fell 65 cents, or 0.7%, to $94.05 a barrel, each down for a fourth day. Gold became consistent at $1,725.17 in step with ounce, getting support from decreased bond yields. Bullion may want to push via resistance at around $1,770 if the Fed gives you a dovish hike on Wednesday. That means a head steerage for a slowing in the tempo of hikes for the rest of the year. Chris Weston, head of studies at brokerage Pepperstone, wrote in a customer note. The yellow rock works on this backdrop in which investors are wondering if the USD is our default hedge against fairness drawdown, Weston stated. I'm warming to gold.